Okay, so it's good to be back. I mean, it's been a while since I'm speaking on stage, looking at in front of you guys. Okay, because of the last 3 years, we have been doing mostly online. Okay, so this year is good to be back face to face. And the clicker is very old school. Okay, that's bad with me, but as long as it works, it's fine. Okay, so today I just want to cover on how you can actually do dividend investing in the inflationary world. Right, so just to see a show of hand, how many already do dividend investing? Wow, quite a number of you. Okay, basically, if you invest in stock that pays dividends, that is called dividend investing. Okay, but that doesn't mean just the definition alone. There are many definitions that you can talk about when it comes to income investing. Okay, so today, of course, we are living in a world where things are getting more and more expensive, right? I mean, I just came back from travel. My air tickets is like 1.5 times to 2 times more expensive. That's what inflation does to our wallet, okay? And even my favorite plate of chicken rice is no longer $3.50, now it's $4.50. And you know, the rice is not 4%, 5%, 6% what they are telling us, you know. The incremental rice is actually 20, 30% more. For my air ticket, it's 50%. For my electrical bill at my home, I look at the bill, it's 50% more, the rate, as compared to pre-COVID. Okay, so it's quite crazy, and this is the official data. The unofficial data is usually much higher, okay? And as a result, I think we are looking at the Fed that actually been raising the interest rate to fight the inflation, okay? The main purpose is basically to slow down the economy so that people hopefully out of job, and then they will not buy more things, and that will pull back basically adjust back the demand, okay? Because the supply for the last 3 years have been quite tough, okay? So, and as a result of higher interest rate, I think we are seeing dividend investing is slightly different as compared to last time during the pre-COVID level, okay? So, since most of you guys here built a dividend portfolio, okay, I just want to share with you how you can actually optimize your portfolio in the world where we live in today, okay? And inflation is not going away anytime soon, right? Because we are probably, second half of this year, I'm expecting probably we'll still see a figure of 5%, 6% in the US. Okay, in Singapore, probably be there about also, okay? So now if you look at most of us here, when we invest in stocks, we do start off with cash, okay? So this is where, you know, you put your money to work, okay? But now before pre-COVID, usually when you put your cash in the bank, the yield in the bank is it high? Low, right? It's like 0. something percent, right? Very low, okay? Today's, of course, you can get 1%. Of course, some banks are actually offering you 2-3% for fixed income for the deposit itself. You should look at this part, because if you are just putting your money in the bank, you are not generating a high yield. Okay, so I will share with you how you can actually put that and maximize your yield itself. Okay, and then I also talk about investing in bank stocks. Okay, whether is it still attractive for you to look at bank stock. Okay, and the third part that I want to cover is income stock. Okay, which is what kind of stock you should invest in this high inflation world. Okay, basically quality stocks. Okay, how you define it, I will talk to you later, okay? And of course, the last part is the REITs, okay, which is now not very popular because of the higher interest rate. People are not investing in REITs because of the higher rate hike, okay? So I'll try to cover all of them, but it's not possible for me to cover in 30 minutes. So I will cover the big picture, okay? And for details, of course, you can check out some of the FSM Academy where actually I did some session with them before, okay? So cash, I think for you guys, if like I said, if you have bank money in the bank, okay, don't just sit down there doing nothing, okay? Park them in the Singapore saving bonds. Okay, don't leave it there, okay? Because the bank is paying you a very low interest rate, okay? Of course, you can put your fixed deposit with them for 12 months, okay? But I can tell you that my preference is always saving bonds, because you can redeem it anytime, okay? And the rate for saving bonds is actually above 3% for the last 6 months, okay? It's been a while since we saw that figure, okay? So look at that numbers. Of course, those of you who have maxed out your saving bonds, you can look at the treasury bills, okay? Treasury bills is also the cutoff point, I think, for the last auction is actually above 4%. Treasury bill, go for short term, 6 months, okay? The idea here is that when you have a cash in the bank, you just want to make sure that it's liquid enough for you to take out anytime, okay? Instead of parking the cash, okay? So for saving bond, you can take it within a month, out within a month. Or you can choose to keep it for the next 10 years for above 3% kind of return. Okay, so I'll show you the Singapore saving bonds for the last 1 year, okay, in 2022, okay, you can see the first half of 2022, the rate was actually very low. These are all the first half, okay, and the last 4 months issuance was mostly above 2.5% to 3%. Okay, so how many of you have been buying Singapore saving bonds? Can I see a show of hand? Yeah, so I can see still quite a large number of group not buying bonds, Singapore saving bonds, right? How many of you basically don't care what I say? You won't raise your hand. Oh, thank you so much, sir. But you raised your hand just now. Okay, so do something with your cash in the bank. Don't park it there idling, earning pathetic interest rate. Okay, this is no risk-free. Okay, government guarantee your return. Okay, unless Singapore government, something wrong with Singapore. Okay, which is unlikely, right? Okay, so and the next upcoming application is unfortunately slightly lower, averaging at about 2.9%. It's still not too bad as compared to your normal bank interest rate. Of course, if you compare to your normal 12-month, there's a lockdown period of 12 months. Okay, so this one no lockdown, 1 month. You can withdraw anytime, no penalty. So that's why I'm actually tilting towards Singapore saving bonds. Okay, so the closing date is 26 Jan. So every month there's one issuance. Go and check out. You can subscribe this under your OCBC, DBS. You log in under the investment. You can actually subscribe for that. Okay, so it's quite easy. And yeah, so of course, then if you max out your Singapore saving bond, check out the Treasury bill. Okay, that is go for short term, 6 months or 12 months. Unless you don't have no intention to take it out, then you can go for long term Singapore government security. You have 2 years, 5 years, 10 years. Okay, those probably will give you a slightly better yield. Okay, but I prefer short term because I like, because 2023 a lot of people are talking about recession, right? Last year's recession, this year also recession. So depressing, right? So you want to stand by cash to take on opportunity when it happens. Okay, next one is Singapore banks. Of course, with rising interest rate, the bank will make more money. Okay, I look at my mortgage. If I were to remortgage today, the interest rate will be higher compared to 2 years ago. So what this means is banks are actually making more money out of our loans. Those of you who take property or car loans or whichever. Okay, so banks historically have outperformed the index in the rising interest rate environment. So you can see in the period of 2004-2006, interest rate actually increased. The one that's in green, the 3 banks actually have outperformed the index itself. Okay, and subsequently there was a rate increment here. Okay, in 2015 to 2019, before the COVID-19, the bank performance also have done pretty well. Okay, so look at the bank because typically they'll benefit from the rise of interest rates. So, and banks pays very steady dividends. Okay, except in 2020, the MAS actually require them to pause the dividend by 50%, reduce the dividend payment. Okay, so and if you look at the valuation, look at price to book. Okay, DBS is expensive for now. Okay, so I don't think DBS is good value right now if you based on their price to book alone. If you look at UOB, it's fair value. Okay, so they pay dividend at the same time. There's a potential capital appreciation that you're looking at. Okay, so yeah, and the yield for the banks is about 3.5% to 4%. So you get the kind of fixed deposit kind of return, and there's a capital gain upside. Okay, so and in the rising interest rate environment, bank will benefit. Okay, OCBC is by far the most attractive among the 3 banks in Singapore. Okay, and of course, you have to analyze the banks, but in summary, I can tell you that banks in Singapore are very safe, okay? Because they are regulated by MAS, and Singapore government is very tight when it comes to regulation for banking industry, because this is a pillar of the country. It cannot collapse, okay? So that is the 3 banks that we have here, okay? So enough for the banks, and yeah, I just want to cover on REITs also, because this is not a very popular topic this year, okay? But I'm a fan of REITs, and I've made quite good money from REITs so far, okay? Touch wood, haven't lose money yet, okay? But it's an investment where, over long term, okay? Don't look at the short term performance. It's very good instrument to invest for income, okay? Because they pay stable dividend, okay? If you invest in the right REITs, okay? Not your first REITs, not your Sabana. Okay, of course, there are bad apples out there. You need to learn how to siphon those bad apples out. Okay, and those good REITs, which I'll share with you one of it later on, will compound your money over the long term. Okay, not only they pay 4-5% yield, which is even higher than your short-term fixed income. Okay, at the same time, it gives you capital upside long term. Okay, so over annualized return, I'm looking at about high single-digit return to teens return. Okay, mid-level. Yeah, so if you look at REITs in Singapore, I think the index value has fallen last year, okay, because of the higher interest rate. It has not benefited from that. Basically, it's being punished. Okay, so yeah, if you look at the valuation, okay, historically, REITs also outperform the index even in the environment where interest rate was rising. A lot of good quality REITs actually managed to perform in terms of dividends and capital gain. Okay, so these are some of the few one: CapitaLand Integrated Commercial Trust, Parkway Life REIT, Ascenders, and so on and so forth. Okay, so look at some of them. Okay, so rental index. Why? Because in the time of good economy, usually REITs are able to raise the rental. Okay, so you don't just look at the cost basis, but you also look at the ability for those REITs to raise their rental. For example, retail. Post-COVID, retail last 2 years has been very tough, 3 years, okay? This year is the time where they start to increase the rental rate because the economy is coming back, okay? And the lockdown is over. This is a REITs price to book ratio. Basically to tell you that the whole REITs sector in Singapore is very cheap, okay? So yeah, I'm short of time, so I will probably quickly talk about it. So look for those REITs that have a quality one, low gearing and high interest coverage ratio, okay? So I won't go into the details. I did a session with the FSM Academy. Go and watch the session if you can, okay? So right, so yeah, so this one, Dasin Retail Trust basically pass the gearing ratio, but if you look at their debt maturity profile, it's pathetic because the maturity is actually very, very short. I mean, if you're an investor, you worry how they can actually refinance those loans itself, okay? Yeah, so even though you buy cheap, you also still lose money, okay? Basically, to tell you that don't look for cheap price to book kind of REITs. You look for quality REITs that are cheap, okay? So example, MyPa3 Pan Asia, this is the quality REITs I'm talking about, okay? And if you look at the price to book, it's very attractive today, okay? And people don't like them. And that is the best time to invest because people don't look at them anymore, okay? So yeah, I mean, I don't want to talk about it. And I still have quite a number of slides to cover, but I think I shortage of time. It's okay, you can catch up with me later, okay? Or you can watch FSM Academy, okay? So thank you so much.